In 2004, a single infrastructure decision changed the trajectory of gold for the next decade. Most people who missed it spent years trying to understand what they didn't see. The exact same type of decision is unfolding inside the Bitcoin financial system right now, quietly, completely out of sight, and the consequences will not be subtle. We're going to talk about DTC eligibility today. We're going to talk about what it actually means when the Depository Trust Company, the backbone of American securities settlement, begins accommodating Bitcoin-adjacent instruments within its existing clearance framework. And more importantly, we're going to talk about what that signals about where institutional capital is actually headed, not where retail sentiment thinks it's headed. If you're new here, this is the wealth continuum. We don't do price predictions. We don't do hype. What we do is pull back the curtain on the structural mechanics that drive capital at scale, the plumbing that most investors never see until it breaks. If that's the kind of analysis you want, subscribe now and hit the bell and drop a comment below, telling me where you're watching from. I genuinely want to know what parts of the world are paying attention to this conversation, because it matters more than you might think. Now, back to the infrastructure. Here's what the surface story looks like. Bitcoin has been trading in a range somewhere between $80,000 and $100,000 as we move through early 2026. The ETF narrative, the one that dominated most of 2024 and into 2025, has matured from a novelty into something more structurally embedded. Spot Bitcoin ETFs now hold a significant portion of Bitcoin's circulating supply. Institutional allocators, from registered investment advisors to family offices to certain pension consultants, have begun treating a small Bitcoin allocation not as speculation, but as a macro hedge, specifically a hedge against dollar debasement and against the kind of sovereign debt stress that no one in the mainstream financial media wants to talk about too directly. The headlines will tell you that institutional adoption is the story. They'll point to inflows, to asset manager filings, to the quiet but consistent accumulation that has been happening since the ETF approvals changed the risk-adjusted math for professional allocators. And they're not wrong. That part of the story is real. But here's what most investors are missing. The ETF flows are the visible layer. What's happening underneath, in the settlement infrastructure, in the custody architecture, in the way Wall Street's back office is quietly being restructured to accommodate digital assets, that's the layer that actually determines how much institutional capital can ultimately enter this market. And right now, that layer is being rebuilt in real time. To understand why DTC eligibility matters so much, you need to understand what the DTC actually does. The Depository Trust Company is not a household name. Most retail investors have never heard of it, but every single equity trade you've ever made, every stock, every ETF, every exchange-traded product, clears and settles through the system. The DTC is the central counterparty infrastructure for American securities markets. It holds something in the range of tens of trillions of dollars in securities and custody on any given day. It's the reason you can sell a stock on Monday and have the cash in your account by Wednesday. For decades, the DTC's eligibility framework, meaning the criteria that determines what instruments can be held and cleared through its system, was essentially a wall that kept digital assets out of the traditional securities pipeline. Not through explicit policy, but through the practical reality that Bitcoin and crypto-native instruments didn't fit the definitional categories that DTC was built around. What's changed slowly and then more quickly is that the instruments wrapping Bitcoin, the ETFs, the ETNs, the structured notes with Bitcoin exposure, have achieved DTC eligibility. And now we're seeing the early signs of conversation around whether certain forms of direct digital asset custody might eventually integrate into DTC adjacent frameworks. Stay with me, because the next part changes everything. When an instrument becomes DTC eligible, it doesn't just become easier to trade, it becomes eligible to be used as collateral. It becomes something that prime brokers can lend against. It becomes something that institutional portfolios can hold not just as a speculative position, but as a functioning financial asset within the existing plumbing of the American financial system. That's not a small distinction. That's the difference between Bitcoin being treated as a commodity sitting in a digital wallet and Bitcoin being treated as a reserve asset with liquidity, collateral value, and settlement certainty. Think about what that means for institutional demand. Right now, the limiting factor for many large allocators isn't conviction on Bitcoin's long-term value. It's operational. It's the question of whether holding Bitcoin, directly or through instruments, creates compliance friction, custody risk, or settlement complexity that outweighs the portfolio benefit. Every time another layer of that friction gets removed, the addressable market for institutional Bitcoin allocation expands. And this is where we need to connect it to the macro environment, because the two things are not happening in isolation. We are in a Federal Reserve policy environment that is, as of early 2026, carefully navigating between two uncomfortable realities. On one side, There is still residual inflationary pressure in the services sector and in the labor market that makes aggressive rate cuts politically and economically dangerous. On the other side, there's a Treasury market that is issuing debt at a pace that is absorbing significant private sector liquidity, which is a form of liquidity tightening that does not require the Fed to do anything at all. Treasury issuance has been running at historic levels. The fiscal deficit, regardless of political framing, requires ongoing bond sales that pull dollars out of risk assets and into government paper. 10-year Treasury yields have remained elevated relative to where they were during the zero-rate era, sitting somewhere in the 4 to 4.5% range. That's not a crisis level, but it's high enough to make the risk-free rate a genuine competitor for capital that might otherwise flow into equities, real estate, or alternative assets. Here's where it gets concerning. In this environment, elevated rates, heavy Treasury issuance, a Fed that is moving cautiously on easing, the traditional macro playbook for Bitcoin says you should be cautious. Risk assets historically underperform in periods of sustained liquidity tightening, and for most of the last 2 years, that framework made sense. But the DTC eligibility shift introduces a variable that the old playbook didn't account for, because what we're watching is not just a liquidity cycle playing out, we're watching a structural reclassification of what Bitcoin is inside the plumbing of institutional finance. And structural reclassifications can overwhelm cyclical headwinds. Let me give you a concrete example of what this looks like in practice. A large registered investment advisor managing, let's say, several $1 billion across client accounts has been watching Bitcoin for years. The conviction is there, the client demand is there, but the practical limitations have always included questions about how to custody the asset, how to report it on client statements, how to use it within a broader portfolio construction framework that relies on DTC eligible instruments for rebalancing and collateral management. As Bitcoin adjacent instruments achieve deeper DTC integration, those practical limitations start to dissolve. The RIA can now allocate to a spot Bitcoin ETF the same way they allocate to a gold ETF. The back office workflow is identical. The compliance team can apply the same documentation framework. The prime broker can handle it the same way they handle equities. That sounds mundane. It's not mundane. It's the difference between a $10 billion RIA putting 0% in Bitcoin because the operational friction is too high, and that same RIA putting 1 or 2% in Bitcoin because the friction has been engineered away. Multiply that across the universe of institutional allocators who have been watching from the sidelines, and you're talking about a structural demand shift that has nothing to do with retail sentiment or macro liquidity cycles. But this isn't even the most important part. The most important part is what happens when Bitcoin starts functioning as collateral within the prime brokerage system. Collateral is the circulatory system of institutional finance. It's how leverage gets created. It's how prime brokers extend credit to hedge funds. It's how pension funds manage their liquidity. When an asset becomes accepted collateral, it enters the financial system not just as a holding, but as a lever, something that can be used to generate additional exposure, fund other trades, or manage margin requirements across a portfolio. Gold achieved this status decades ago. Treasury bonds are the ultimate collateral. Investment-grade corporate bonds sit a tier below that. And now, Bitcoin ETFs, and potentially Bitcoin itself, are beginning to inch toward collateral acceptability within certain institutional frameworks. This is a slow process. We are nowhere near the point where Bitcoin is accepted as collateral at the same level as treasuries. But the direction of travel matters enormously, because once an asset achieves even partial collateral utility within institutional systems, the demand dynamics for that asset change fundamentally. It's no longer just something you buy because you believe the price will go up. It becomes something you hold because holding it generates optionality within your entire portfolio. Comment below. Do you think it's liquidity cycles or structural adoption mechanics that will ultimately drive Bitcoin's next major move? I'm genuinely curious where this audience lands. Now, let's bring in the global dimension, because this story doesn't exist in a vacuum. The dollar has remained structurally strong through this period, even as the Fed has been inching toward easier policy. Part of that strength comes from the interest rate differential. The US still offers a higher yield than most developed market peers, which attracts capital. Part of it comes from the dollar's reserve currency status, which creates persistent demand regardless of policy. But there is a growing undercurrent of dollar alternatives that is quietly reshaping how capital flows globally. Stablecoin adoption, dollar-denominated digital currencies that run on blockchain infrastructure, has now reached a scale that is difficult to ignore. Tether and USD Coin together represent hundreds of billions of dollars in dollar-pegged value circulating outside the traditional banking system. In emerging markets, stablecoins are increasingly being used not as a speculative tool, but as a practical substitute for access to dollar liquidity. particularly in countries where the local currency is under pressure and where the banking system's access to dollar reserves is constrained. This is significant for Bitcoin for a specific reason. The stablecoin ecosystem and the Bitcoin ecosystem are deeply intertwined. Most Bitcoin trading globally still flows through dollar stablecoin pairs. The growth of stablecoin infrastructure, the on-ramps, the exchanges, the wallet systems, is simultaneously building the infrastructure through which Bitcoin is accessed by a global user base that has no access to Vanguard ETFs or Fidelity brokerage accounts. The real shift is happening somewhere else. While Western institutional allocators are navigating DTC eligibility and ETF flows, a parallel process is occurring in countries like Argentina, Turkey, Nigeria, and across Southeast Asia, where populations with acute exposure to currency devaluation and banking instability are adopting Bitcoin not as an investment, but as a savings technology. This dual demand structure, institutional in the West, monetary in the developing world, creates a demand base for Bitcoin that is broader and more durable than any single macro cycle. Let's talk about what history tells us, because we've seen versions of this structural shift before. In the early 2000s, gold was going through a similar institutional legitimization process. It had always been a store of value. Central banks held it. But for most institutional allocators, gold was operationally complicated to hold in size. Then the SPDR Gold Trust launched in 2004, creating a DTC eligible vehicle that allowed institutional portfolios to gain gold exposure through the same infrastructure they used for equities. What happened to gold over the next decade is well documented. The analogy is not perfect. Bitcoin is not gold. The macro environment is different. The velocity of institutional adoption is different. But the structural dynamic is similar. A previously inaccessible asset class achieving operationalized legitimacy within the existing financial system is infrastructure, creating a demand expansion that was disconnected from the asset's underlying fundamentals. And here's the parallel that I think is most instructive. When gold ETFs launched, the mainstream financial narrative was that gold was a relic, a hedge for paranoid people, not a serious portfolio asset. The structural demand that developed over the following years had nothing to do with converting gold skeptics into gold believers. It had to do with removing the friction that had prevented existing believers from allocating at scale. We are watching that same friction removal process happen in Bitcoin, but faster, and against a macro backdrop that provides additional structural tailwinds. Hit, like if you think macro cycles are the primary engine of risk asset pricing. And share this analysis with someone who thinks the next Bitcoin move is obvious, because the next move may be the least obvious thing in this market. Now here's where I want to be direct with you about the uncertainty, because this is where the analysis has to be honest. The DTC eligibility story is structurally bullish. The institutional adoption mechanics are structurally bullish. The global stablecoin infrastructure story is structurally bullish. But none of those structural forces protect Bitcoin from the immediate term impact of a liquidity shock. Let me walk you through the three scenarios that I think define the realistic fork in the road from here. Scenario 1, the Federal Reserve begins a more meaningful easing cycle in the second half of 2026. Treasury yields decline, dollar liquidity expands, risk assets broadly benefit. In this environment, the structural demand from institutional adoption combines with cyclical liquidity expansion to create the kind of price appreciation that makes narratives feel self-evident in retrospect. Bitcoin in this scenario is operating with both macro tailwind and structural tailwind simultaneously. This is the scenario that retail optimism is largely pricing in right now. Scenario 2, inflation proves more persistent than the Fed anticipated. Services inflation and a resilient labor market keep the Fed on hold longer than markets expect. Treasury yields stay elevated. The dollar remains strong. In this environment, the cyclical headwind is real. Risk asset multiples compress. Bitcoin, despite its structural adoption story, trades within a narrow range as institutional allocators who have already made their initial allocation pause before adding more. New money comes in slowly. The DTC eligibility story continues to unfold in the background, but it doesn't produce a dramatic price catalyst in the near term. This scenario is uncomfortable, but not catastrophic. Scenario 3. A global financial stress event, a sovereign debt crisis in a major emerging market, a banking system disruption in Europe, a geopolitical shock that disrupts trade flows, conditions, creates a sudden de-risking event in which correlations across asset classes rise toward 1. In this environment, even structurally sound assets sell off as institutions raise cash and manage margin. Bitcoin has shown in previous cycles that it is not immune to this kind of correlated sell-off. The DTC eligibility mechanics actually introduce a new dimension here. If Bitcoin ETFs are being used as collateral within prime brokerage systems and a margin call cascade begins, the very infrastructure that makes Bitcoin more accessible to institutions can become a transmission mechanism for forced selling. You need to understand this before the next major move happens. Structural bullishness and near-term volatility are not contradictory. They can and do coexist, and the investors who get hurt in volatile markets are almost always the ones who confused a structural thesis with a guarantee about short-term price behavior. Let me bring this back to the custody dimension specifically, because I think it's underappreciated even within the Bitcoin-focused investment community. Custody has always been the quiet gatekeeper of institutional capital flows. Before an institution can buy an asset in size, it needs to have a credible answer to the question, where does this live? Who holds it? What happens if the custodian fails? And how does our auditor treat it? For Bitcoin in its early years, none of those questions had satisfying institutional-grade answers. Crypto-native custody solutions existed, but they weren't integrated with the traditional systems that institutional compliance and operations teams were built around. The risk was not just that the asset might go down in price. It was that the asset might be inaccessible, uninsured, or treated in a legally ambiguous way that created liability for the fiduciary making the allocation decision. That picture has changed materially. Major custodians, including some of the largest names in traditional asset management, now offer Bitcoin custody services that are integrated with institutional-grade reporting, insurance frameworks, and regulatory clarity. The OCC guidance issued in prior years established that federally chartered banks could provide custody for digital assets. The SEC's evolving framework around SAB 121 and its eventual modification created more clarity for how public companies and financial institutions account for digital assets on their balance sheets. Each of these developments is a brick removed from the wall that kept institutional capital out, and this is where the DTC eligibility story connects to the broader custody story. They're both part of the same infrastructure build-out. They're both part of the process by which Bitcoin transitions from a parallel financial system into an integrated component of the existing one. And this is where institutions are seeing something different from what retail participants see when they look at a price chart. Most people look at this market and see price. Institutions don't. They see liquidity profiles, settlement certainty, collateral utility, and custody infrastructure maturity. And across all of those dimensions, the institutional grade characteristics around Bitcoin are improving, not because the asset itself changed, but because the infrastructure around it has been rebuilt to support it. In institutional finance, there's a concept called the investable universe. This is the set of assets an institution is actually allowed and operationally able to hold. For most of Bitcoin's history, it sat outside that universe. Not because institutions banned it, but because the operational framework didn't exist. There wasn't reliable custody. There wasn't standardized settlement. There wasn't regulated ETF access. And there wasn't integration into the traditional clearing system. That's now changing. The eligibility shifts tied to the Depository Trust Company and the maturation of institutional custody and the launch of spot ETF structures are steadily moving Bitcoin deeper into the investable universe for larger pools of capital. But here's the part most people misunderstand. Institutional capital doesn't move quickly. At large asset managers, the timeline from initial research to actual allocation can take 12 to 24 months. The ETF approvals in early 2024 are still working their way through internal committees, risk frameworks, and portfolio models today. We are in the middle of that pipeline, not at the end of it. And this infrastructure story connects directly to a much bigger macro reality. The United States government is entering a period where massive amounts of existing debt must be refinanced at higher interest rates. Bonds issued during the low-rate era are now rolling over at significantly more expensive levels, quietly increasing the government's interest burden. This creates a structural constraint for the Federal Reserve. If rates stay high, fiscal pressure intensifies. If rates fall too quickly, inflation risks return. There is no clean exit from that trade-off, and that's where the long-term argument for Bitcoin strengthens, not as a short-term trade, but as a structural hedge against currency debasement risk. This isn't a fringe idea. It's the same macro logic driving central bank gold accumulation to multi-decade highs. It's the same framework discussed in global currency cycle research by Ray Dalio. And it's increasingly the lens institutions are using when evaluating Bitcoin as a portfolio diversifier. The difference is infrastructure. Gold has centuries of institutional integration. Bitcoin has barely over a decade, but that gap is closing. And it's closing faster than most people expected. Right now, the market is trying to price two forces at the same time. First, a structural institutional adoption trend that is clearly underway. Second, a macro liquidity environment that still creates uncertainty. Those forces are in tension. The infrastructure story argues for patient accumulation. The macro environment argues for caution. But what matters most is this. The friction that historically kept institutional capital out of Bitcoin is being systematically removed. Custody clarity, ETF access, clearing integration, accounting improvements. These are structural, not cyclical changes. And structural changes rarely announce themselves in price immediately. They happen quietly, inside regulatory filings, custody upgrades, and internal policy shifts at large institutions. Then one day, capital begins to flow. And by the time it becomes obvious on the chart, the opportunity has already moved. The next major move in Bitcoin may not be driven by retail sentiment or even the next rate decision. It may be driven by something far more powerful. The completion of the institutional infrastructure build-out that allows the largest pools of capital in the world to allocate, not because they suddenly became believers, but because the operational barriers finally disappeared. And that's the shift most people are watching the wrong screens to see. The wealth continuum, structural analysis for the long game. If this gave you a new lens on how institutional capital actually moves, share it with someone who's still watching the price ticker and thinking, that's the whole story.